A House committee today held a hearing on lending to small businesses and its effect on job creation. Among the witnesses, small business owners, bankers, and economists. Congressman Sam Graves of Missouri chairs the House Small Business Committee.
Call this hearing to order, and I want to thank all of our witnesses for being here today. We look forward to hearing your testimony. Apologize for just being a little bit late, as we had a vote called. As America seeks to recover from this recession, which has obviously been a terrible blow to a lot of folks, we are going to be relying on the nation's small businesses to help lead the way. For small businesses to expand and create jobs, they need adequate financing. However, small businesses are telling us that access to capital remains a hurdle in the current economy. Despite rallies on Wall Street and government efforts to loosen credit, in fact, on the other side of the equation are lenders who say that they have capital available, but businesses are not as creditworthy as they were just a few years ago. Banks claim that today's borrowers have lower credit scores and lower collateral value due to the depressed real estate values. If we want our nation's entrepreneurs to grow their businesses and create jobs, then we are going to need to bridge the gap between lenders and small business borrowers. We have called this hearing today to examine the challenges that both small businesses and banks are facing when deciding to expand or to lend money. And in addition, we're going to examine alternative kinds of financing for small businesses and the avenues available for businesses to get the capital that they need. Again, I am very pleased to have several distinguished witnesses here today to provide members of this committee with insight about the importance of capital for small businesses and the impediments leading to lending that banks are experiencing today. I think this is going to be a very good hearing. It's a very timely hearing, obviously. And with that, I'm going to yield to the ranking member for her opening statement, and then we'll get started.
Thank you, Mr. Chairman. Job creation is understandably a top priority for all Americans right now. New data out just this morning suggests the economy added only 38,000 jobs in the month of May. As these new numbers show, large firms cut their workforces this month. We could clearly use some of the small businesses' job-creating power right now. In order for small firms to play their traditional job-creating role, several factors must be in place. Perhaps the most important ingredient is the availability of capital. If small businesses are truly the backbone of the economy, then the flow of capital is the lifeblood. Although challenges remain, there has been progress in this area. Small business loan approvals in the first quarter of this fiscal year are up 15% over last year. Fewer small firms are falling behind or defaulting on loans, suggesting they are in better shape to take on additional debt and hopefully expand. Lending through the Small Business Administration is always critical for entrepreneurs seeking affordable capital. However, during economic downswings, when credit is tight elsewhere, the SBA's role becomes more important. Several provisions this committee crafted in the Recovery Act temporarily boosted SBA-backed lending. Raising guarantees on the SBA 7A loans gave banks greater incentive to make small business loans. Other provisions made the loans more affordable for borrowers. As of now, those steps have demonstrated the most quantifiable, proven results. Other recent policy actions have yet to exhibit the same level of success. Examining the amount of SBA lending is only one metric. For these loans to ignite real job growth, the agency must concentrate on the right kind of small businesses, namely startups with the highest potential for job creation. On average, it costs nearly $75,000 to launch a new enterprise, a tough proposition under even the best circumstances. Unfortunately, these small startups are not seeing their fair share of SBA loans. During the first half of fiscal year 2011, less than 1/4 of SBA loans dollars went to startups. It is my hope that today's discussion will generate new ideas about how Congress, the SBA, and the lending community can expand all small firms' financing options, but especially for those at the earliest stage of the business cycle. As the committee moves forward, we should examine the full spectrum of capital options for small firms. Some businesses will do fine through conventional loans, while other entrepreneurs can meet their capital needs with microfinancing. For startups, a debt-based solution may not make sense at all. Investment capital might be a better fit. What works for a small manufacturer in Ohio may not be appropriate for a family farm in Tennessee, to say nothing of a technology startup in Lower Manhattan. On that note, I would like to thank our witnesses for taking time off busy schedule to be here with us. Their diverse views and experiences will be valuable to the committee as we consider how best to meet entrepreneurs' capital options and needs. I yield back, Mr. Chairman.
Thank you, Ranking Member. If any other committee member has an opening statement, I would ask that you submit it for the record, and I'd like to explain the lights to you real quick. Each of you have 5 minutes, and the lights will be green. When you get down to a minute, it'll turn yellow, and then it'll go red. We'll be a little lenient on that, but please try to stay within the 5-minute mark. Our first witness today is William Hall, who's the Chief Executive Officer of William G. Hall and Company. Mr. Hall is a Dairy Queen franchisee, and you have 5 locations in Texas, I believe. Mr. Hall also serves on the Board of Directors for the International Franchise Association and chairs their Credit Access Committee. We appreciate you being here today. Obviously, you came a long way, and look forward to your testimony.
Thank you, Chairman Graves. I want to thank you as well as Ranking Member Velasquez and the rest of the committee. Thanks for having me here. 5 minutes, hard for me to say hello, but I'm going to do my best here. As you said, I'm a Dairy Queen franchisee in Fort Worth, Texas, and I'm a member of the International Franchise Association Board of Directors. But I want to talk about the important role in the U.S. economy of franchising holds. As Ms. Velasquez mentioned, small businesses and startups are an important part of our economy, and franchising meets that need, but with a little bit of a lifeline for the first people in the first role in the business, because they do have a system of training and it allows someone to start a business without being in business totally by themselves. The franchising world grew at a faster pace than the non-franchising world up to 2008 when we had the financial meltdown. Since then, recovery has been very slow. Markets have been frozen, very difficult to obtain any sort of financing. We greatly appreciate the work you guys did on the Small Business Jobs Act. Those SBA provisions have been a lifeline for franchising. It's something that we really do appreciate. And but currently, other than SBA, there's very little lending out there for the entrepreneurs in the franchising world. To survive, the franchising community has, we cut back. We did live with what we had. We didn't add new jobs. We didn't remodel where we needed to, because we were caught in a situation where we just couldn't borrow any money. And that was pretty much across the board. That's small to large. It impacted all sectors. We delayed the new store acquisitions. Franchisors were in a problem because they couldn't put new people into their units because they couldn't get the initial financing. People would pay the franchise fee, but they couldn't get the initial financing to get going. We think that small business creates 6 out of 10 jobs in the country, and if we don't have access to credit, then we're not creating the jobs that we need. We think there's a 20% shortfall in the lending to franchise this year, and the SBA has been critical in filling the need, but we're still going to be 20% short, and that means there are a lot of jobs not going to be created that could be if we had normal access to credit. Franchising is all about small business. Franchising sometimes gets confused because people talk about McDonald's, even Dairy Queen, as being large companies. I started from nothing, had nothing, and most of the people I know in the franchising business started with 1 unit and grew from that. We are resilient as a group. We are diverse as a group. In the franchising industry, 19% of the franchises are owned by minorities, whereas in the non-franchise sector, there's 13% owned by minorities. So we have a great program for veterans that come back home. Over 400 franchisors have put in a program to give a discounted startup opportunity for veterans. We feel like that's been a fantastic program and well received and great opportunity for our veterans coming back. As I said, in the franchising world, you're in business for yourself, but not by yourself, and that's a tremendous benefit, which does in fact put us into a position where we could be a good borrower for these lenders that want to make loans, which they need to make loans to be successful. So we thought, how could we solve this problem without any other help from anyone? And we decided as a group to get together and from the franchising world and reach out to the lenders to try to show them what we had to offer, because we knew they needed to make loans. So as a franchise loan, we think it's a better loan than a non-franchise loan, because you do have the system in place. There's training, there's support. The franchisor does underwriting before you go to the lender, so there's some safety there. What we did is put together a credit summit to bring together all the parties. I don't want to take the committee's time to go through it, and I don't have the time, but I would ask the chairman if we could perhaps introduce this piece into the record, which does describe the credit conference we had, brought together lenders and franchise folks to try to come up with a solution, a private sector solution to the problem. As we go forward, we need help in this regard. We need to help our lender friends to be able to loan money to us. We're going to do our part. We're good loans. We're not trying to look for a bad loan. We're trying to put a proven loan that can be made and paid back. But we do need help because those markets are closed to us right now. Without the SBA lending right now, we'd be a lot less people employed in the U.S. And with their help and your help to them, I know there'll be a lot more jobs available. We're not looking for a bailout. We just need access to credit so we can grow our businesses and to provide more jobs. And I want to thank everyone for having us here. I'll be happy to answer any questions. Thank you.
Thank you, Mr. Hall. Our next witness I'd like to introduce is Lynn Ozer. Ms. Ozer is the Executive Vice President of the Small Business and SBA Lending at Susquehanna Bank, located in Pottstown, Pennsylvania. Ms. Ozer is representing the National Association of Government Guaranteed Lenders, where she has served on the Board of Directors since 1988, I believe. So thanks for coming, and look forward to hearing what you have to say.
Chairman Graves, Ranking Minority Member Velasquez, and all the members of the committee. As Chairman Graves mentioned, I am the Executive Vice President at Susquehanna Bank, where I manage SBA and all government guaranteed lending throughout our bank's 4-state footprint. Susquehanna Bank is a Pennsylvania state-chartered bank with approximately $14 billion in assets and operates throughout 223 branches in the Mid-Atlantic states. Susquehanna is active in both SBA's 7A and 504 programs, currently holds a portfolio of approximately $300 million in government-guaranteed loans. I'm also here representing more than 700 members of the National Association of Government Guaranteed Lenders, NAGL. For the past 23 years, I've served on their board of directors, and for many of those years, I've served on their executive committee and as chair of the technical issues committee. NAGL's lender members are responsible for approximately 80% of the annual 7A volume, as well as most of the lender portions of the SBA 504 loans. Thank you for inviting me to testify and for holding this hearing on the important issue of small businesses' ability to access capital. In the interest of time, I will submit my full written testimony for the record and provide just a brief summary. I want to begin by publicly thanking the International Franchise Association, IFA, for taking a leading role driving the discussion on the direct correlation between access to credit, job creation, and economic development. Because of the exemplary efforts, both NAGL and IFA, today we have a 7A loan program that is much better able to meet the capital needs of America's small business. And it is important to note that the IFA work on this issue did not end with the passage of the Small Business Jobs Act. Approximately a year ago, while we were working on credit access issue on different tracks, NAGL and IFA began a dialogue that we have continued. Through those encounters, we came to realize that there is a significant overlap in the issues affecting both organizations' memberships, and to note that each group has much to learn from each other. So IFA and Nagel have forged a partnership intended to increase the availability of capital to franchise small businesses. A highlight of IFA's ongoing efforts to address the credit issue was the Credit Summit that IFA organized and delivered in April. Bill Hall, chair of IFA's Credit Committee, has briefly described some of the things that IFA is doing, but because neither he nor IFA will tout the organization's work to bring attention to this important issue and IFA's continuing commitment to this effort, I want to do that for him and them. I also want to specifically mention the exemplary leadership shown by IFA's CEO, Steve Caldera, who has worked tirelessly to highlight the important role that access to credit plays in creating jobs and increasing economic output. The most important message that I can bring to the committee today is to reiterate what you already know. SBA loans are critical to keeping small business segment of the economy, the biggest job-creating segment, healthy. We're seeing signs of economic recovery, but for a variety of reasons, accessing capital continues to be difficult for small businesses. Lenders want to be able to provide this necessary capital, but they're experiencing a perfect storm of circumstances that together serve to stifle the conventional small business activities, lending activities. So how are banks meeting the credit needs of their small business customers? Many lenders are increasingly turning to SBA loan programs, and in particular to the SBA 7A loan program. Having a healthy 7A program is essential to keeping credit flowing because SBA is the single largest provider of long-term capital to U.S. small businesses. Its loan guarantees account for well over 40% of all long-term small business loans made in America. From the lender's viewpoint, a key benefit to the 7A program is that it takes less capital to support an SBA loan than it does a conventional loan. From the small business viewpoint, the SBA guarantee allows increased access to capital, particularly to the kind of financing that appropriately matches the loan term to the life of the loan assets being financed. That is, finances long-term assets with long-term loans. According to the federal statistics, typical 7A loan has an average original maturity of 12 years, while conventional small business loans typically have an original maturity of 3 years or less, with a significant majority of those loans having maturities of 1 year or less. Longer maturities allow small businesses to access capital that would not be available to them if repayment were required in substantially shorter periods. The importance of SBA lending to small business clearly demonstrates by recent demand for the program. According to SBA, in the last 2 years, the 7A and 504 guarantees enable private sector lenders to provide approximately $42 billion in loans to small business. However, the success of the 7A program this year is causing a new problem. Based on the loan approvals to date, it appears highly likely that the program demand will exceed the $17.5 billion program level ceiling set by congressional appropriators. This means that it is likely that the 7A program will have to shut down sometime late this summer unless the Congress acts to raise the program level. In order to avert this potential program suspension, Nagel, on behalf of its members, is requesting that Congress act now to increase this year's program level for SBA's business loan programs to $19 billion. This increase will not affect the budget because sufficient appropriations are already available to support the increase to the program level ceiling. We know small business lead the way to creating new jobs, and we know that having a vibrant small business segment in our economy is vital to continuing the fragile economic recovery that we are seeing. We also know that keeping SBA's 7A and 504 loan programs available to meet the capital needs of tens of thousands of credit-worthy small businesses that now have nowhere else to turn is equally vital. Do I still have time left? Okay. Sorry. That wraps it up, and I will be available to answer any questions.
You'll have more opportunity when we get to questions.
Okay.
I'll now turn to Ranking Member Velasquez to introduce our next witness.
Thank you, Mr. Chairman, and it's my pleasure to welcome and introduce Dr. Dennis Jacobe. He is the Chief Economist at Gallup. In this role, he leads Gallup efforts to understand consumer public opinion and the economy more broadly. He has designed many of Gallup's special financial indexes, including the Small Business Index and the Investor and Retirement Optimism Index. Dr. Jacobe is currently focused on the application of behavioral economics to the overall idea of financial well-being. Welcome.
Thank you, Ranking Member Velazquez and Chairman Graves. I'm pleased to be here today. As you mentioned, I'm Gallup's chief economist. The comments today are my own, not necessarily those of Gallup. We at Gallup are concerned about the economy, and I'll summarize my statement very quickly, but we interview 1,000 Americans every night, and we've done so since the beginning of January 2008. And we ask them various questions about the economy, and then we look at those results and report on them on a weekly and monthly basis. And what our numbers show us is what you saw in some of the economic data today, and that is the economy is softening. We have seen it for quite a while. We think by asking Americans about how they feel about the economy, that we get some insight into where it is headed. And so although the economic data you're seeing today lags a little bit, we think our numbers are being confirmed by what's happening now, and that is we are certainly in a soft patch, potentially in a stagnation or stagflation situation. Some of the numbers that we get show that consumer spending simply has not been increasing, and at the same time, we're seeing unemployment at very high levels. The number that will come out Friday, I'm not sure what that will be, but Gallup measures its own unemployment rate. Our number for May is 9.2%. That's not seasonally adjusted as an unemployment rate. But when we look at what we call underemployment, that is the people who are unemployed or people who are working part-time looking for work, the number goes up to 19.2%. And we think people underestimate what the effects are on society and the economy of having 1 in 5 Americans unemployed or underemployed. In addition to the sort of daily monitoring, we do something we call the Wells Fargo Gallup Small Business Index. And what we do in that is we survey small business owners across the country and ask them a variety of questions to try and measure the small business operating environment. I've inserted a chart in my testimony, but basically what happened is early this year, as consumer confidence was up, so was small business confidence and was recovering from the last year and a half when it was low. In our latest measure in April, small business confidence went down. We think that does not portend well, but it fits with our other measures in terms of the economy overall. Now, in terms of credit availability, as part of that index, we measure and ask small business owners what they feel the credit is available to them as small business owners. In my testimony, I include a chart that shows that about 30% of small business owners say that it is difficult or very difficult to get credit right now. Now, that number may seem small, but it's about 3 times what the difficulty of getting credit was rated by small business owners prior to the recession. In terms of getting whether credit is easy to get, we have about 20% who say it's easy to get, obviously those that are stronger financially and the rest, but that number is down from over 50% prior to the recession. So there's a slight improvement in credit availability for small businesses, as has been mentioned by a lot of people, but it is far down from pre-recession levels. There are a couple of different things that I think are very important having to do with job creation in small businesses. I won't go through that discussion in detail, except to say that we find that about 40% of small businesses tell us that they're hiring less people than they need. We think that if we can turn that around and actually get them just to hire what they need, not necessarily to grow, there could be really an explosion in terms of job creation that is unexpected by most economists. The question is how to do that effectively. And 3 areas that I mentioned that are not mentioned often, I think. One has to do with education. I'd be glad to discuss that, but I think there needs to be some tie-in to education from our polling with small businesses. The housing and real estate area, which you've heard more bad news about this week, which is another area that's very important to small businesses, and then finally some of the energy problems. I'll be glad to answer any questions.
Thank you. Next, going to turn to Representative Landry for introduction of our final witness.
Thank you, Chairman Graves and Ranking Member Velasquez. I would like to introduce Mr. Bob Kottler to you all. Although he's based up here in D.C., Mr. Kottler is a Tulane grad. I think Mr. Richmond, Cedric's not here, is our other. We have a Tulane grad on the committee, actually. A former executive at Louisiana's own IBERIABANK and is currently the executive vice president near my hometown at IBERIABANK in Lafayette, Louisiana. And this may make him a certified Cajun. He may be able to understand me if any of y'all have problems. Mr. Kottler has capitalized on his banking and finance expertise and has devoted much of his career to working on what makes small businesses work. In his current role at IBERIABANK, Mr. Kottler is responsible for the retail segment, including retail operations, credit cards, sales, retail training, and small business. Before joining IBERIABANK, he was the executive vice president for small business banking at Capital One, covering Texas, Louisiana, Maryland, Virginia, D.C., New York, New Jersey, and Connecticut. I don't know how you connect Texas and Louisiana to the East Coast, but his team worked in tandem with Capital One's National Small Business Credit Card team. Mr. Kottler also headed Capital One's branch real estate division in the Texas area and served as Hibernia's chief sales support officer before Hibernia and Capital One's merger. Mr. Kottler started his involvement with the Consumer Bankers Association in 1995 as a member of CBA Small Business Committee. He has been extremely active over the last 16 years in his roles such as chair of the membership committee and member of the board of directors for 10 years. In total, Mr. Kottler has nearly 20 years of practical experience in providing small business access to capital and credit. Mr. Kottler, thank you for your service to our communities in Louisiana and throughout the other states, and I'm proud to have you testify before us all today.
Thanks, Mr. Kottler. I think Mr. Landry used up all your time.
I think so. I was going to say that was a hard one to follow.
I yield.
Go ahead.
Thank you, Chairman. Good afternoon, Chairman Graves and Ranking Member Velasquez and members of the committee. I'm excited to be here today. As Congressman Landry said, I'm Bob Kottler, and I'm responsible for retail and small business banking at IBERIABANK, and also a member of the Consumer Bankers Association Board of Directors. CBA has been the recognized voice of retail banking, including small business lending, for the nation's capital for 90 years. In my positions at Iberia and CBA and 21 years of experience in small business lending, I understand the challenges we face, and especially getting through the current economic environment. Over the past few years, high unemployment has resulted in less consumer spending, and consumer spending is critical to boost sales of small businesses and make them healthy. The decline in sales and the weak economic conditions have led to weaker than normal and inconsistent demand for small business loans. In fact, a recent NFIB study found that poor sales and uncertainty continue to be greater problems for small business owners than access to credit. In addition to the decline in sales, another factor that's diminished the demand for lending is value of home equity. And as many of you know, home equity is traditionally a strong form of collateral that many business owners use to secure their business loans. A December study by the Federal Reserve Bank of Cleveland found the decline in home values has constrained the ability of small business owners to obtain the credit they need to finance their business. It's also important to understand how the decline in sales and home values has affected small business lending. When banks underwrite loans, we look at two things: cash flow, both historical and projected, as well as the collateral securing the loan. And the decline in these two criteria over the economic cycle have been significant factors behind the reduction in lending and make it clear why lending has been so difficult. But we do see it improving. CBA members report increases in demand for small business loans. In addition, the Commerce Department announced an increase in consumer spending for the 10th straight month, which we think is a positive sign that we are turning the corner. So what is CBA doing to improve lending? Many banks have instituted aggressive second look programs where the banks will take a look at a loan that might have been declined and see if there is a way to approve it, and are looking to find ways to make more quality loans through that process. A number of banks have also announced new lending programs and commitments to small business, and many CBA members have established enhanced training and incentives through the branches, which is often the primary place our customers come to ask for loans, and also specifically improving use of SBA programs. CBA supported and will continue to support the efforts of the committee and Congress to expand small business lending and economic development. We believe SBA program improvements, including 7A, 504, and Express, are important, and also the Small Business Lending Fund and other enhancements. And all of those things are taking us in the right direction to make more loans. This spring, CBA joined with the International Finance Association to sponsor a small business lending summit here in Washington, D.C. And through that summit and the dialogue that we've had with IFA, we've looked for ways to improve lending. As a result, CBA's Small Business Committee is now working to develop a template that franchises can use to prepare their potential franchisees to secure the financing they need. This template will provide the bank information about the franchise and hopefully will help us successfully underwrite the loan. One final point I wanted to stress is the importance of communications between borrowers and lenders, even before a request is made. The better prepared and knowledgeable a borrower is about the process, and the more that a lender knows about the borrower, the more successful the outcome. Small businesses and lenders alike need to work harder to bridge that divide and better understand one another, and that's one of the things that we've been working on with the IFA. In closing, we're just starting to see signs of growth in our economy, but we think we have a ways to go. Any successful small business needs to have sufficient demands and goods in order to have strong cash flows to prosper. And we think as the unemployment rate falls, demand will increase, which will continue to improve small business lending and small business growth. And CBA looks forward to working with this committee and small businesses to strengthen our nation's economy. So thank you for the opportunity to testify, and I'll be available for questions. Thank you.
Thank you, Mr. Kottler. I'm going to pass my line of questions to the end of the hearing because I have a lot, but I'm going to turn to our first member, Mr. West. Questions, 5 minutes.
Thank you, Mr. Chairman, also Ranking Member Velasquez, and thank you, panel, for taking the time to be here with us. We just had a very interesting morning. We went over and met with President Obama, and one of the interesting topics we brought up is what we're discussing here today as far as lending, and especially the regulatory burdens that we place upon our small businesses. One of the things that the President said was that these are independent regulators down dealing with our small businesses, and the government doesn't have any effect upon them. So what I'd like to know, is that really the case? Or have you seen an increase of government regulators coming down that are restraining or restricting the lending practices for our small banks? Because that's a very important relationship we have to our small businesses. So I'll defer to our bankers first, and then, of course, Mr. Hall.
What we found is that the FDIC regulators are inconsistently applying regulations throughout the banking community. That's what's been reported to the Trade Association.
I think that I think the banks that are members of CBA have not seen a lot of regulatory impact. We're always concerned about it. But I ultimately think that it's really the improvement in the economy that's really keeping more loans from being made. That's really the primary influence.
Well, from our, by the way, Mr. Landry, I'm from Texas. No problem understanding you. I got it. Mr. West, I think the issue is from a franchise perspective, we are hearing that our borrowers are being inconsistently treated in some ways, or that the bankers are being inconsistently treated. At least that's what the bankers are telling us. I have some banking interest myself, and I do know it is very difficult for the individual banks to know what to do. They're sort of just like we are in our business. It's very difficult times for the small banks. And so we hear in the franchising side that there are significant restrictions on credit based on the inconsistency of the regulators. And I don't know enough about it. I'm not trying to pick on FDIC or anybody else. We're just trying to find a solution to the problem.
Well, can you all give examples of these inconsistencies, just one or two maybe?
I can tell you what I heard, but I don't want to. These are the bankers. I'll defer to the bankers. unless they don't answer, and then I'll tell you.
Hot potato.
Okay, you know, what we hear is that the SBA loans, and again, I know we had Mr. Grunberg, was the vice chairman of the FDIC, speak at our credit conference. He clearly said, we're trying to help you in this effort, but we hear what's happening is that it's not getting filtered down to the local examiners, and that what's happening is that at the local examination level, they're looking at SBA loans as being more risky because they are guaranteed and therefore are substandard, and so they're getting pushed over into a more restrictive line within the individual banks. You know, we think franchise loans are good loans, but because they're SBA loans, there's apparently some bias against that. Again, I'm only answering because you asked me the question. So,
well, this is the same information that we've heard as well. And some banks on the government-guaranteed loans are asked for higher reserves than others on the same guaranteed versus unguaranteed portion. So it's been handled inconsistently. And then just exactly what Mr. Hall was saying is as far as the classification of the loan and the risk rating, and then that naturally affects how much capital has to be reserved for those loans.
Absolutely. Well, thank you. And Mr. Jacobe, one question. In your estimation, what are the two economic policy silver bullets that would enhance access to capital for our small businesses and help us to sustain a growth environment?
I wish there were silver bullets, but two things that would really help. I think one is stabilizing the housing and real estate markets. I think that as you hear from the bankers in terms of how small business loans are made, and I've worked with bankers for 25 years, and they tell me the same thing, and that is a lack of collateral. A lot of that is allied to the housing situation. The second thing has to do with education. When we did our polling prior to the recession and prior to the financial crisis, one of the things we found was that small businesses had problems finding people who were skilled and had the skills they needed so that they could grow. That remains a problem, and when we polled recently, among the other problems, they still can't find the skilled people they need and talented people they need in those areas that are growing. So those are the two things I would focus on.
Thank you very much, and I yield back, Mr. Chairman.
That's the last question.
Thank you, Mr. Chairman. Dr. Jacobe, in your testimony, you discussed that while credit conditions have improved for small businesses, they're still considerably tighter than they were in 2006, 2007. And I know that you mentioned three factors. One of them, the housing and real estate markets. But do you see, based on the surveys that you take every night, any conditions that are improving so that we could be to a point where we were 5 years ago?
Well, actually, until about January of this year, we started to see a lot of things improving, and I thought we actually were going to build some economic momentum, and that has been sort of dashed in the last couple of months. I think that we could build surprising economic momentum, and we could really get back there if we can unleash this kind of pent-up demand in the small business sector and just do a few things basically nationally that we could really recover very much more quickly than people think.
Can you imagine where we would be today if we were not infuse capital in terms of helping prevent the capital collapse, the markets, capital markets from collapsing?
That's really interesting. Last night I was watching Too Big to Fail, and during the period of time when all those events took place, I was polling nightly, not only national consumers but also banking customers. And I could identify very well with some of the feelings that are portrayed in that show. It's really hard for people to go back and imagine what conditions were at that time. But at that stage, I was among the group of people who would support almost anything because we were really afraid that things were going back to the stages of the 1930s. Now, I know a lot of people don't agree with that anymore, but that's where we fell.
And it is interesting that you know that the Small Business Index had increased 40 points between July 2010 and January 2011. What do you attribute this increase to? And do you think that the federal stimulus play any role?
Well, I certainly think that, and people disagree about how effective the federal stimulus was and all of those kind of things, but we really did see the economy start to recover from a really bad point about a year ago. And our numbers and consumer optimism and everything really did start to pick up late last year and to early this year. I think it was a combination of things having to do with a lot of uncertainties being removed in the economy, and people were much more optimistic.
And you just make a comment that the economy is softening, and given the numbers that we heard in terms of job creation, adding only 38,000. And that could have an impact on capital availability or credit availability for small businesses. Up to this point, last year, we passed the Small Business Lending Fund under the Department of the Treasury, and it's supposed to provide capital to the banks so that they could lend to small businesses. Up to this point, only 626 financial institutions have applied for the Treasury's SBL, and none has been approved yet. So do you see this initiative having a major impact on small businesses' ability to secure capital?
I don't think that anybody really expected to have a huge impact from that program, at least the people I talked to, particularly out in the banking business, that was really going to turn things around. And so I'm not really surprised by the result. There are a bunch of issues around that program that just make it difficult for small banks to take advantage of it. And I'm not sure that it will help in what I see as softening that's coming.
When we were debating the legislation that created the Small Business Lending Fund, one of the concerns that I raised was the fact that in the language, there was no requirements to the banks to lend. If you take that money, if you access that money, it should go to small businesses. So in light that we do not have that requirement, what do you think will have the impact it will have on small business access?
I'm not really optimistic that the program will have a major impact. It's a little uncomfortable for me because I think conditions are bad enough that we ought to do anything we can. So if anything that provides hope in this kind of area, I'm for. But, you know, in terms of expectations, I wouldn't have great expectations.
Okay. I'll have questions for the other witnesses, but I will do it in the second round. Thank you, Mr. Chairman.
Mr. Butler.
Thank you, Mr. Chairman. And my questions are going to be a little bit more directed to you as well. I really found it interesting in the survey you provided us. When 40% of our small businesses are not hiring as much as they could, we're not talking about, it's difficult to create new businesses, right? In my state legislature, I heard a lot, let's get new capital and expand. And I kept thinking, we need to protect the business owners who are currently, those small guys who are struggling right now should be our immediate focus. That's the quickest way to get job growth in our country. I have 13, 14% unemployment. I've had double-digit unemployment for 3 years now in my biggest counties. And it's because we're primarily a small business-based economy. And I was looking through these answers that they gave you. 79% said they were worried revenues or sales wouldn't be able to justify the new employees, right? So no one's going to buy what they're selling, so it's not worth it to expand. Worried about cash flow or ability to make payroll. I can tell you I've had a lot of small business owners who have not taken a paycheck in several years to keep their employees employed. Hard to find qualified employees, which alludes to your education component. And then worried about the potential cost of health care. that's something we haven't talked about at all here, and we had a panel on it a couple months ago. The only thing that I was surprised I didn't see on here is with regard to the regulatory environment, and maybe healthcare fits under that, but this is really much more, this is much more big picture. It's not this regulation or that regulation. Is that not something that even registered with this part, or or was it cloaked in the answers for these questions?
I think it's overcome by the other answers. It's sort of under there somewhere, and when we've had larger sample sizes, it does show up, but it's a much smaller percentage than the items
that get that specific. It's a regulation. Okay. So going back to the certainty and the confidence issue, you had 3 suggestions or solutions. Each one of them could take us a significant amount of time. How do we stabilize the housing values? And education is obviously more of a state responsibility, but there are federal workforce programs that we could align, perhaps. And then energy. And I know we're working on gas prices here. Get more supply out there, and hopefully we can drive down the costs. In getting to these 3, where would you suggest we start?
I think that the most important thing that could be done, and I know this is not the view of a lot of people, is that we need to do something about housing. I think that housing has effects across the country that are underestimated. It has had a major impact on small business, on the collateral the small business has, the ability to lend, the wealth of the American people. And in terms of going forward, we have a broken housing finance system. I used to be a housing economist many years ago. And if you go back in history as to how housing was really stimulated, that has a tremendous impact on communities and on growth of small businesses and then on the country. So I know that that's not a topic that's being generally discussed, but I think that's really, we're not going to get this economy going to potential without housing. We get housing going, I think the growth is going to be a lot faster than most people think.
Thank you. And I yield back.
Ms. Chu?
Mr. Kottler, you talked about the decline in lending having more to do with drops in cash flow and home collateral values over the years, and that increased capital requirements and regulatory uncertainty have made it difficult to lend. But I wanted to look at the underwriting standards. What are the current underwriting standards for applicants seeking loans for their small businesses, and have they changed over the last 3 years?
I think that as the economy worsened, there's no question that banks became banks were worried about the uncertainty and certainly spent a lot more time asking questions of borrowers and making sure that we would make loans that could be repaid, so we didn't replicate the problems that caused some of this in the first place. I think we really look at 3 things when we underwrite a loan. First is the cash flow of the business, both how the business is done historically, and then the projected cash flow. So what kind of contracts do they have? What kind of opportunities do they have? And I think one of the difficulties has been that obviously as the economy has been tough over the last couple of years, the historic cash flows of our businesses don't look as good as they did in the years before the downturn. So that certainly goes into the underwriting. The second piece is the secondary source of repayment or the collateral of the borrower, and that's where housings come in, commercial real estate appraisals come in, and clearly we've all been very cognizant of making sure that appraisals are right and that they represent the true value of the property. And then the third is generally, especially in small business, the personal guarantees of the business. And we'll look to the owner of that business to make sure that they're strong and can also support the business through any issues it would have. So I don't know that it's as much that the underwriting has changed more than being very cautious to make sure to go through each of those steps. And in a lot of cases, the borrower doesn't look as strong as they did in the years before the downturn.
Are there any barriers, though, in the process that could keep a business owner from securing a loan, even though they actually might be a good candidate for the loan?
I'm not aware of any. I mean, I think that banks are in the business of lending money. It's what we do, and I think that we all want to make loans. I can tell you in my business, if it grows, that's what we want it to do. So I think the real issue is just getting the economy on track, getting the jobless rate down, removing any other uncertainties that would cause small businesses from expanding. I think if those things happen, then I think we'll begin to make loans. I'll also tell you that our lending is up considerably from the bottom, but we're still not all the way back to where we were as an industry and as an association, our members from the top.
Well, I looked with interest at your at this program by the Consumer Bankers Association, of which you're a member of the board of directors, the Second Look program.
Yep.
So what would trigger a second look at a good candidate for a loan?
I think that oftentimes loans will get declined by an underwriter, and so what we did is, when that happens, we put many of our member banks put processes in place to have a supervisor or their manager or another underwriter take a look at those loans to see if there's another question we could ask, more information we could get, additional collateral that would make the bank comfortable, but something to try to take a look to see how we can make loans. And our members have seen anywhere from we polled our small business committee anywhere from 3 to 20% lift in the approval rates of those loans. So it's actually worked. It's been something that's been successful in helping small businesses for our industry.
Ms. Ozer, you look like you have something to say on this.
What I was going to add is the Second Look program is just something that a lot of that we do at Susquehanna and other banks that participate heavily with the Small Business Administration is we do, as a second look, see if we can utilize the Small Business Administration's guarantee on these loans that don't meet our credit criteria on a conventional basis. The credit criteria of our bank in particular, and I believe I'm speaking for most banks, the credit box itself has tightened due to regulations and losses and so forth. But what that means is that the businesses that no longer qualify for conventional lending fall off their plate and land on mine as the director of government guaranteed lending. So that's why we've been doing more loans, because we do look at the same exact criteria that Mr. Kottler was speaking about, but with the enhancement of the government guarantee, we're able to make more loans to small businesses by utilizing that, and that's why the vitality of that program is so important.
Thank you. I yield back.
Mr. Mulvaney.
Thank you, Mr. Chairman. Briefly, I think one thing that we heard earlier bears repeating. I was as surprised as Colonel West was when we met with the President this morning and were told by him from his own mouth that he had very little direct control over the regulatory environment. And Ms. Ozer, you mentioned that one of the hurdles that you had been facing in your business dealt with the FDIC. So I ask you, ma'am, who oversees the FDIC? Is it Treasury?
I think it's an independent agency.
I believe
it's under
Treasury, which would be Mr. Geithner, who is a presidential appointment. We actually have a meeting with Mr. Geithner in a few minutes, so I'm going to ask him directly about his role over the regulatory environment. I was very surprised to hear that. But let's come to the issue at hand, and I have a question for Mr. Kottler. You heard Mr. Hall talk about the role that franchising plays. I've been a franchisor, I've been a franchisee, and he's absolutely right. There's a tremendous pent-up demand in our industry. Traditionally, our industry has been sort of a stabilizer. It's been counter-cyclical. When business got bad and people got laid off, they would turn to franchising as a way to start their own businesses. We saw that in our own business. The demand for our restaurants went up dramatically, but the ability of people actually to open them fell to zero because no one could get financing. Mr. Kottler, let me ask you this. You've talked about what is preventing you folks from lending, and I heard all the things that I would ordinarily expect, which is your cash flow and your collateral. It makes perfect sense to me. But my question is this. Is there anything that we can do or perhaps undo as a government to help you lend money? And I'll give you the example that I take from another industry, which is the real estate industry, which is having a great deal of difficulty refinancing right now. And it's in large part because of regulation, that there's a rule in place now that says if you refinance a real estate loan, even though it's perfectly healthy and performing, if you refinance it, it automatically goes into a troubled asset category. And to me, that shows some opportunity for us to fix things. So I put it to you, Mr. Kottler, what can we do or undo to help you lend money to folks like Mr. Hall?
I think one of the things is be supportive of the SBA programs. A lot of our banks use them. And the increases that were done in the amount to lend and some of the other things that were done there have been pretty important, and banks have used that pretty aggressively through this economic environment to make loans. I think that's the primary thing, other than just the more global economic things that I just think we have to continue to work on, and that'll take care of a lot of it in the process.
Mr. Hawley makes an excellent point, and you talked about the fact in your testimony that if there were no SBA lending out there, we'd have almost none in our industry. Have you ever done an SBA loan?
No, sir, I have not.
Has anybody, well, I know Ms. Ozer has. Ms. Ozer, could you tell us the difference in terms of the paperwork involved behind getting an SBA loan and a traditional loan? Maybe Mr. Kottler could help on that as well, because it's not apples to apples. It's much more difficult to get an SBA loan than it is an ordinary free market loan.
The amount of credit information that's required from the borrower, the basic credit information is the same. In order to do your due diligence and the underwriting process that the Congresswoman had asked about before, we need the same amount of financial information. However, when you are applying for an SBA loan, there are rules and regulations, standard operating procedures that have to be followed. So if you decide to borrow money from a bank who has expertise in that area, there should not be a huge amount of difference for the individual borrower. But you do need to have a lender that has experience in that, because there's credit underwriting on the bank level, and then there's credit underwriting that has to be done on behalf of the Small Business Administration. So there is basically 2 times the amount of work. You can use the same credit underwriting, but you do have forms and applications that need to be done, eligibility checklists that need to be done, tracking of use of proceeds, and there's more of an administrative burden on the bank to do an SBA loan. But the borrower themselves shouldn't really be experiencing more problems.
I had the great pleasure of having an SBA loan one time. It was a great experience, don't get me wrong, but it's between going the SBA route and the conventional route was always preferable. Yes, sir, Mr. Hall.
Well, I would add that while I haven't had an SBA loan, it looks like I'm going to be going after one. And and I'll just give you the real world perspective on that. In the past, you know, if I put a new unit in or put a restaurant in, I'm typically putting a lot of capital in there already in addition to the loan. And in times past, I may not have had to guarantee the loan personally. In fact, I wouldn't do it unless I absolutely had to. In today's environment, every bank is making me guarantee that loan personally. So now, faced with the fact that I probably can't get the loan at the commercial bank, I'm now saying, okay, well, I got to go through SBA if I want to expand my Dairy Queens, which I'm currently looking at right now. I am probably going to expand my Dairy Queens to refurbish them through an SBA program, because that's really the only route I can take. Now, am I excited about, 1, the paperwork, and 2, personally guaranteeing it with everything I have when I'm putting a lot of capital into it? No, I'm not, but I don't really have a choice if I want to renovate my units. So that's the response about the SBA.
Thank you, Mr. Hall. Thank you, Mr. Chairman.
Mr. Peters.
Thank you, Mr. Chairman. I want to talk a little bit about, back to the bankers' situation with making loans, and I know how the deals have changed, but there seems to be 2 issues with the banking industry that I found in talking to my community bankers, credit unions, and others, is that certainly the deals that are coming to you are different, cash flow is different, collateral is different. But in terms of some of the questions we've been getting from some of the other panelists as well with the FDIC involvement, is that oftentimes the FDIC will go into a community bank, for example, is what I'm hearing, and I'd like you to respond, is that they'll go into the community bank and say, basically looking at your portfolio, and saying your collateral that you have backing up your portfolio, real estate, for example, has dropped, so your collateral has dropped. As a result of that, you need to have increased reserves, which seems to be a prudent thing to do, is to increase reserves as your collateral has dropped. But that, of course, limits your ability to lend, because you either got to bring in private capital, which is a difficult thing to do in a tough economy. A lot of small banks don't look like a great investment to people, particularly in my area. Or you've got to actually call in loans or reduce your ability to lend. So a question to our 2 folks from the banking industry, to what extent is it the fact that you're having trouble finding creditworthy borrowers, and to what extent is it the fact that just because your own portfolios have dropped, collateral has dropped in value, that you simply don't have the capital to lend? What is that balance?
You know, I can tell you from our experience at IBERIABANK, we've been very well capitalized and had very good lending performance through the cycle. So I will tell you that one of the reasons that I came to Iberia was to do more small business lending. That was something the bank management of the bank wanted to do. And as a result, I don't think my experience is, that at least at our bank, that's been an issue. The issue is really...
But more broadly than your bank, is it an issue?
Yeah, you know, it's interesting. I've attended some different forums over the last few years, and some of the smaller banks have certainly raised that issue. But I will tell you from my experience that our bank is $10 billion. In my experience at a larger bank, I don't think it was.
My experience with our bank is similar in that we have been capitalized and have been able to lend throughout the crisis. We do have issues with loan loss reserves, and on a conventional basis, they are looking more closely because of regulations and the types of collateral that they're able to use. The equity values have decreased, but we have available to us the way to make loans is to utilize the government guarantee, and we have been able to do that and to conserve capital, because that's one of the major things that program allows us to do. The creditworthiness of the borrowers, you know, at the present time, the people that you're looking at now that come in to borrow money, their expenses are lean and mean, and most of them have a top-line problem and not a bottom-line problem because of the consumer spending. And those are the things, you know, that makes the banks nervous. And, you know, we use the government guarantee to do that. On a conventional basis, a lot of banks are requiring borrowers to pay off their credit lines that they've utilized all the way, and they don't have availability on it. And then with an SBA guarantee, we can give them 10 years to repay that loan, as opposed to the banks requiring only a 2, 3, 4-year loan. So by applying a guarantee to it, we increase the working capital available to those borrowers to keep them in business.
Let me jump in with your use of the SBA, which is an important part for you, is that there's some discussion on the fees that are assessed on SBA loans, that traditionally those fees have covered all the cost of the program. However, now it's being subsidized, and I know the administration and others have concerns about the subsidy of the fees. Although the fees can be relatively high for a small business right now, what impact do you think it would have if we do not are in a position where we don't subsidize those fees, actually have to raise those fees? Are you concerned? And maybe that's to all the panelists. Are you concerned about having to face even higher SBA fees?
On a personal basis, I mean, the borrowers have that concern, but this also touches on what Mr. Hall was saying. You know, when you utilize an SBA guaranteed loan, it's because credit is not available elsewhere. So these small businesses are either fighting to stay in business or they want to fight to start business. And the fees can be financed and amortized over the life of the loan, which is generally a longer period of time than they would get on a conventional basis. So as a lender, yes, it's concerning. As a borrower, I'm sure that it's concerning as well, except for that if you're in a situation where it is the most reasonable way to continue in business or start in business, then we're going to continue to do it.
You know, I have a financial background. I'm a CPA, which I started 8 years doing that, and I've been an entrepreneur since then. And unfortunately, the question I'd ask the bank now is not about the fees, but what's the payment?
Yeah.
You know, it's a situation where you need the credit, you need to finance something. You're going to pay a higher fee and be willing to pay a higher fee than you ever thought you would. It's the same as the example I gave on the personal guarantee. There was a time I said I'd never personally guarantee a loan again. Well, I'm eating those words today, because to get a loan, to expand, to even survive, I'm going to have to guarantee that personally and put on the table everything I've worked for all my whole life. But I'm have to do that to grow.
Right. Thank you, Mr. Chairman. Yield back.
I'm going to jump in here real quick because we're going to have a series of votes here coming up here after bid. I don't know when they are, but I do have a question for you, Mr. Hall. And you mentioned earlier, and I've heard this too, about you know, a possible bias out there against making it harder for franchisees. In fact, I've got friends who are trying to get loans on startups that are new franchises, and they get that impression that there's a bias against that, or it's that much tougher. Can you expand on that a little bit? And I'd be very curious to hear what the others have to say too, and in the banking community.
Well, you know, I think historically people have had a negative thought about restaurant industry and about startups just in general because, you know, the SBA program is not about giving away money to loans that won't pay back. I mean, it's a program where you really have to pay the money back, and there has to be a plan in place. And so I think there probably has been traditionally a bias against some of the franchises, but I think we're turning that around partially with the work the IFA is doing with these other organizations. Because to us, it's about, we look at it as the glass is half full rather than half empty. You know, we're not putting the blame on you guys. This is our responsibility. We got to operate. We got to grow, and the way we're doing that is working together as a group with some other people that need to make loans. And the things that we're doing are like the underwriting issue that was brought up earlier. We accept some of that responsibility. We probably weren't given the right information to these folks because we didn't know what to do. So through the leadership of Steve Caldera and IFA, we're creating this environment where we're showing our members, both franchisors and franchisees, how to make that loan application and the things that the bank needs to be successful. So hopefully we are going to overcome that bias that I think has been out there. But I certainly know that it has been there, but our effort in the future is going to be try to overcome that. I don't know if that answers your question.
Any other thoughts? Anybody?
I mean, I'll add that, you know, I think that startup loans are the most difficult loans to finance. They oftentimes have the least equity going in. There are oftentimes people who may or may not have been in that business and want to do something new. So I think the issue is less of a bias and more of just they're just harder to do. So I think one of the things that we've talked with IFA is our CBA Small Business Committee has put together a template with a series of questions for the franchise, how successful your franchise has been, and a whole series of questions. And we're hoping as an industry that by starting that communication that we'll have more success with startups, because I do think they are the most difficult things to do.
Well, let me back that up with a question, too, and I'd be very curious from everybody when it comes to startups, and, you know, this is the age-old question, too. If you're not wealthy, you're very limited when it comes to your personal guarantee. But you're trying to do a startup, you have a good, you know, business plan. You know, is there anything that can be done to make that process a little bit easier, because those are the people that I worry about more than anything else. We got some great ideas out there in many cases, but if that individual isn't wealthy, they don't have the personal backing or that personal guarantee, the equity out there. So is there anything that can be done? And I'll just run right down the line. We'll start with you, Mr. Hall.
Well, you know, traditionally what's happened is those initial entrepreneurial type efforts have been financed by friends, family, other outside people. They beg, borrow, and steal whatever they have to do to get probably the wrong words, but they do whatever they have to do to get started. And I think that is sort of what's happened. I think also in the franchise industry as well. We have a lot of people coming into that their initial capital is coming from what we call angel investors, which is somebody that has a personal relationship with them. Very difficult to get any institutional type investor to get involved in any kind of these small business type loans that we're talking about. But as a rule, I think that initial capital comes from just the effort from the individual. Very seldom in my history of being in business have I seen a startup like that be able to go in and find a place, other than through some foundation or something, get the startup monies. So my personal experience is normally they have to take the first step to get into business, which is one reason we love the franchise business, because they're not taking that first step totally by themselves. They can accumulate some of this money. They can get in business with support from someone else to help them be successful going forward and to grow.
Ozer?
I agree totally with what Mr. Hall was saying. When you look at, as I have for years, projections and business plans to begin with, we see lots of people that we suggest they go back to the small business development centers, they go to the SBA offices, SCORE offices, and so forth to work on their business plans. But the initial equity, when you talk about that, that is the most difficult part. The hardest loan is the startup capital. They go to friends and family and angel investors, but we won't do 100% financing. And what we find a lot of times, what I see is that these people have access money from credit cards. And a lot of times we see that that's how they start their businesses. And then if they do have this wonderful idea, they come to us where they've already proven some top-line success and they have credit card debt. And that's one of the beauties of SBA lending. We can refinance credit card debt over a longer period of time because they've already proven that they can pay it on a small basis, and that's how they get it. But the initial capitalization, if you don't have it, you have to get a gift letter from your friends and family. You have to get investors. If you could sell the bank on your idea, then maybe you can sell it to somebody else and bring on partners and so forth, because they do have to have some percentage of monies to do that. I have information here on the percentage of startup loans that were done by the SBA, if you're interested in hearing that.
Very much.
Mr. Chairman, would you yield?
Yes.
I do too, by the way.
Yeah.
And and that is my frustration, because when we passed the jobs creation bill, it was with the purpose of helping provide capital, affordable capital, to those who were not able to get it through conventional financial institutions. And what we have seen is that the federal government and SBA is guilty as charged, because what we are seeing is a concentration on big loans. Those of we increase the loans from 2 to 5 million, and the percentage of smaller loans defined as those less of 150,000 has declined through SBA guarantee loan from 17% to 8%. So the problem with this recession, compared to other recessions, is that people lost their jobs and they started up businesses. They created businesses. This time around, because credit standard has tightened and SBA hasn't helped, because basically those guarantee lenders are concentrating on making the big loans. Debt financing do not create jobs. Startups, they do.
With all due respect, the 7A startup volume is up 6.3% in numbers and 38.8% in dollars in 2011 year-to-date versus 2010 year-to-date. There's 29% of the number of loans to startups, which is defined as businesses open for 2 years or less. There were 10,474 loans made to startups so far this year versus 9,856 last year. And the startup dollars are $3.255 billion year to date versus $2.346 billion last year.
Yeah.
So it's up higher
from SBA.
But the information that the thing that I have seen just in my bank is there's been a lot of startups because there are a lot of people out of work, and some of these people that are out of work actually do have money as a startup to start their businesses because they've either been laid off with a package or they're older, more successful people that have lost their jobs, and they can do capitalization. So we are doing them. And as far as the small loans falling off, a lot of people are using the SBA Express loans less, but they're using the larger loans more. But we need those larger loans because as companies grow, like Mr. Hall is saying, people that have 5 and 6, they get above the $2 million. They have to renovate their stores. They need $5 million. So in my shop, we make loans the whole gamut.
I want to go back to my original question, and that is, I'm talking about people who are doing startups that don't have the equity out there for the personal guarantee. I'd be very interested to hear what you have to say, Mr. Kottler, about that, or what can we do, or what can be done to help those individuals out. I mean, we hear a lot about, those people that have that money or have, something to back them up, but I'm talking about those people that don't.
Yeah.
What can we do in your experience, or what can be done in your experience?
I think it's an ongoing process. So I don't think there's one silver bullet that gets it. I think it's a combination of them finding personal funds or other or friends and family to get started, coming into the bank and working on business plans and beginning a discussion. I think one of the most interesting things to me is that customers who come in and have discussions about what they're thinking about with their banker and get to know them long before they actually come in for the loan request have that helps a lot. And I think then just making sure that we have programs with SCORE and SBDCs to help out. In a bank that I worked for in the past, we actually worked with the Kauffman Foundation to do first-time business owner training, somewhat similar to some of the first buyer homeowner training. That was very successful. The people that graduated from those programs were more successful in their businesses than other startups. So I think there's a whole bunch of different things that we just need to put together to make it work, as opposed to one big thing.
Jacobe, do you have anything to add?
Well, we've done some surveys asking small business owners from their experience starting, what did they do right and what did they do wrong. One of the things that they highlighted was not starting with enough capital. They tried to get in and they didn't have enough capital to make it. And I think in this environment, some availability of at least some kind of minimum level of capital is even more necessary, because they're not going to have immediate success. And so you don't want a lot of people going out there and trying in this environment without some kind of capital foundation.
What do we have next? Who's next? Who's next?
Thank you, Mr. Chairman. Ms. Ozer, you testified before that the issue is really a demand issue or a top-line issue, so that for businesses, they don't have adequate demand really to support a pro forma that allows them to come to a bank and secure a loan, and that is inhibiting their ability from a financial perspective to come in and be successful in the loan process, because they need to grow the top line in order to be successful, to have the ability to repay the loan. Is that a fair summary of where you think many businesses are at?
I'm not sure that we're communicating on the same. I'm saying that existing businesses right now, not startups.
Right,
I'm not
correct.
talking about pro formas. I'm saying that what we're seeing is that the bottom line is profitable, but some of them have been experiencing downward trends in the top line, so that in order for us to make a loan, we need to see year to year that either the bleeding has stopped and they can still pay, or that it's back to increasing again.
Okay, but that obviously puts them in a position where there is not as much demand for bank loans. If they're not having growth in the top line, they clearly don't need a line of credit, for instance, or to increase their line of credit, because they're not buying additional raw materials or additional product for resale.
Well, they're still funding their receivables, and sometimes they need to have short-term capital so that they can fund their daily activities. If they're not a cash business, even the level of business that they're doing, they still need short-term credit lines in order to operate on their regular cash cycle.
But they're not increasing the level of their borrowing, I'm assuming.
Well, it all depends. I mean, a lot of them have, they still need to maintain it, and some of those
I didn't say maintain, I said increase. They're not increasing their borrowing because they don't have additional sales or additional product that they're purchasing.
But they need to grow.
Mr. Kottler, Mr. Hall, do you want to comment on that?
Yes, sir. Let me just put it in a Dairy Queen perspective, 5 Dairy Queens, and my sales are not going up dramatically, but I'm about to have to borrow money to renovate those facilities to maintain my existing business, or else you can be in business and not keep up with the competition, and you're just slowly going out of business. So I would say to you, certainly in my personal case, I am going to borrow money without the expectation of greater sales. I hope I get them, and I hope I'm able to get a higher bottom line, but at the end of the day, I'm probably going to have a lesser bottom line, but I'm still going to be in business. And I think there's a lot of that going on that maybe doesn't make much sense to you, but if you think about it, I've got my base, and if my base goes away, then where do I get my money? So I'm willing to accept less profit to grow, but what I'm also doing is growing jobs, keeping people employed, and keeping my system in place.
Would it be fair to characterize what you're doing as more in the form of a capital loan as opposed to a working capital loan?
Well, in my business, it's just I got to have enough to make payroll, and so when I have to borrow that money to do the construction, it certainly that would be a capital loan. Mm-hmm. But I'm telling you, in a business environment right now, your margins are so thin that you just literally there's no big cushion. We don't have a big pile of money sitting in a bank waiting. We're figuring out how to get where we need to be. But I just wanted to respond to your point about the idea of there will be a situation. You can't always look at this and say, I'm going to get this much return, and certainly in a small business environment, because partly it's about the family. It's partly about keeping these people employed and keeping our business going.
And obviously some of this would be cured by increased sales.
Be great. Love to have it. Love to have it. More blizzards is good for me. I
also want to go back to something that Mr. Jacobe said before, and that was you focused on housing. If we solve the housing problem, that would do a number of beneficial things, including presumably increasing available collateral for loans. What is the solution there? I'm curious as to the bankers we have on the panel. Do they have a substantial amount of foreclosed properties that they're holding on their balance sheets, or is that not an issue for your banks?
I mean, for my bank, it's not, but certainly for a number of our member banks, who are some of the largest banks in the country, they certainly have been working through those issues. But I think from the standpoint of housing value, we talk about startups and other kinds of small businesses, and once a borrower gets beyond personal credit cards and personal savings, the place that they oftentimes go to next is to pledge their house,
right?
Either as a personal loan or a business loan to fund their business. And as home equity values have gone down, especially in certain parts of the country more than others, it's taken away that source of collateral, which has made it more difficult.
Mr. Jacobe, what is the solution?
Well, I wish I knew. The real solution is to get a bottom in housing and a bottom in values, so that everybody can start improving from that point on. And what the danger now, if you've seen the latest reports, is that everybody is fearing the double dip in housing, another step down, and that has the same kind of repercussions throughout the economy. I think that traditionally Americans have valued home ownership. Some people seem to be moving away from that, but I think the nation needs to value home ownership and do whatever it can to stabilize housing and get people buying again in a secure environment. If you're going out to buy a house today, leverage works reverse. It works against you. And so if the price of the house you're going to buy goes down by 5%, you can lose your down payment. The point is you've got to stabilize that to get things going. And I think people underestimate how important housing is to the future of the economy.
Thank you, and I yield back.
Mr. Kaufman.
Thank you, Mr. Chairman. There's been discussion about some of the banking regulators, and in my community, some of the smaller community banks were particularly hard hit, and their concern was that they felt that there was an overreaction, to some degree, that they were paying for the sins of the big banks during the financial crisis, and that for example, their capital reserve had a 20% increase early on in this crisis, and their market niche seemed to be commercial real estate, which was particularly hard hit. I wonder if you could comment in terms of small business access to capital related to community banks. In your view, was there an overreaction by the regulators? Anybody?
Well, we're a little bit larger than a community bank, having $14 billion in assets, but our commercial real estate division was the most hard hit in our bank. So as far as an overreaction is concerned, the perception is that the amount of capital that you have on reserve now is going to be looked at. If they say that it's supposed to be 10%, then you really need to have 13% or 15%. So as such, I don't think that they've overreacted. Well, are you saying the regulators overreacted?
Regulators to the community banks.
I don't know the answer to that. I just don't know if they overreacted, but they reacted appropriately in some cases.
Yes.
From a borrower perspective, most of the borrowers I know think there was an overreaction, especially at the smaller bank level, because that was the most given response as to why they couldn't get the same credit they'd had in the past. We're facing increased regulation, and that's so from a borrower's perspective, there certainly is a perception out there, and just as a general comment, I mean and the regulators in good times, it seems to me they ought to be a little more conservative in trying to get you to put stuff back, and then in bad times, seems like they ought to be trying to help the good borrowers get through the tough times, because we're talking about people who have had a long history of performance, and because of really something they really didn't have much control over, are having to have struggle. Now, unfortunately, I think the community banks are in exactly the same position. So that, again, gets back to our RFA program, where we're trying to match these two people. We kind of both have been in the same position, see if we can get together and get some supply meeting the demand situation.
I've had a number of community bankers inform me that that even if they had performing loans in commercial real estate, that those loans were downgraded, and they should have been just maybe a watch put on them, but not downgraded that would cause them to pull money available for lending into their capital reserve. Anybody else comment on this? Okay. Well, just one last related question, and that is in terms of job creation, which is the subject of today's conference. Access to capital is very important. But what in the majority of, I was a small business owner, I had a sub-business corporation, and the majority of small businesses are structured as sub-business corporations. In terms of job creation, what would be the impact of increasing the income tax rates on job creation, knowing that in sub-business corporations that essentially that's the tax rate that you pay? Would anybody like to comment on that? Please.
Sucker. I'm a sucker for this. As a small business owner, as you know, as you've already articulated, most of the money just flows through from our businesses to our personal income tax return. And I don't, there's nobody going to tell you we want more taxes. I'll tell you right now, though, I'm not afraid to pay what is fair and what needs to be paid. But on the other hand, we've been hit with the alternative minimum tax, as a lot of people have been hit by that over a period of time as it just creeped up. People that their business income is flowing through to their personal tax return, and they're not getting any deductions, and it's difficult. I know it sounds like a lot of money, but I'm telling you, in today's environment, you're trying to survive and capitalize your business out of your personal situation, which is what all small business people do. There are some issues as a taxpayer. I don't want to have to pay more taxes. I'm willing to pay my fair share, and I want to pay my fair share, but I also have to survive. And I will tell you, if you start taxing, and unfortunately I'm afraid the same situation with healthcare, you're going to lose jobs. You don't realize it, but you are, in the real world, you're going to lose jobs. It has to happen, because there's no other, we're squeezed so tight right now that there's no place for it to go.
Thank you, Mr. Chairman. I yield back.
Ms. Clark.
Thank you very much, Mr. Chairman. Thank you, Ranking Member Velasquez, and I'd like to thank our panel for their insightful testimony today. We all understand only when all of our nation's small businesses are active participants in a robust recovery that adds jobs will our nation fully recover from the recent economic downturn. I also understand that allowing the regulatory environment to return to one that allowed for the financial collapse in the first place is irresponsible at best. Today's testimony, especially that of Mr. Jacobe and Mr. Kottler, illustrate the difficult task facing our nation, with the lack of consumer spending highlighted as the top concern of small business owners with regards to hiring. This fact itself feeds back into the anemic consumer spending. The fact that private lenders are not lending even to those who would otherwise be deemed creditworthy has led to the issue that Ms. Ozer pointed out regarding the 7A program approaching its ceiling later this year. So my question is this: given that there's a need and also recognizing that returning to lax regulatory environment that caused our current problem would be unwise, what else is needed to incentivize private lenders to free up the capital that would allow small businesses to expand and hire, which in turn would turn around the weak consumer spending and get our economy back on track?
That's a really tough question. I think there are a lot of things that could be done that would encourage local lenders to hold more loans. Everybody who's tried to figure that out has had some difficulty in terms of how to do that effectively, and you've tried with various kinds of programs. You know, the big thing is to try and get consumer spending again, and that's a larger issue. Once that happens, then everything turns positive. If in the interim you can figure out a way to get lenders to hold more loans themselves instead of the government programs, but get more loans in some kind of incentive way, that would help also.
Yes.
Well, I think that, you know, utilizing the government programs is helping us to do that. But even at that level, I agree with Dr. Jacobe in the fact that the consumer confidence and the consumer spending is all hand in hand, and that's all tied up with more jobs, more disposable income, and so forth. So if we can continue to try to get the money out there to businesses that hire people, then the outlook will go on. But it's a very difficult situation, and I tend to agree with him that until the home level, the values in their homes comes back, and they have confidence that they're not going to lose their homes, and that's their priority, is where they live, and that they have jobs and money to put on the table. When that comes back, I think that the banks are doing everything they can with the tools that they have to get money out there to small businesses. I know that in our bank, you know, someone else asked about the foreclosure rate. If the people are paying on the loans, we're working with them and not foreclosing, even though they've been downgraded, because the regulators are forcing us to downgrade because the LTVs aren't there. But if the loans are being paid, they're still in the bank. So, you know, the banks are trying to work with the people that they have lent money to keep the businesses going, to keep people employed, to keep people spending money. It's just a cycle.
Okay. Mr. Kottler, did you want to?
I mean,
you're a Capital One. You got to have the answer.
No, now I'm going to.
What's in your wallet?
That's right. I'm not there anymore, but I did work at Capital One. But you know, it's interesting when you watch borrowers. So in a robust economy, you see borrowers coming in and they want working capital lines of credit to hire new people, to fund new contracts. They want to purchase new equipment, which then leads to more people to run that equipment, to more jobs. Coming out of the bottom of this recession, what we saw was we started to see loan demand go up, but it was for things like, I want to buy the building that I'm in because I've been leasing it and now it's worth less and I can get a good deal on it. I want to, I want to buy my competitor who's weakened, and I can do that. And those things, those kind of loan requests don't necessarily create jobs. So as we get more consumer spending and we get more economic growth, then we'll start to see those kind of loans from established businesses be the kind of loans that say we're willing to commit and expand. And that's not, we've seen less of that up to this point.
Did you want to add anything at all, sir? Yes. Okay. Well, I'll yield back the balance of my time. Thank you again.
I want to thank all of you for participating today. And this committee is going to, this committee is about job creation and helping small businesses. And we're going to do everything we can to try to make sure we do what we can to provide access to capital for those small businesses. Particularly, the ranking member and I are very committed to helping those startups as best we can. But again, I want to thank all of you for being here, and I would ask unanimous consent that all members have 5 legislative days to submit statements and supporting materials for the record. Without objection, that's so ordered. And with that, the hearing is adjourned. Thank you all very much for coming in.